ServiceNow reported another quarter of over 20% growth. Subscription revenue accelerated to 24.5% growth. AI crossed $1 billion in annual contract value, and management raised full-year subscription-based revenue. On the surface, this was the exact data that I wanted to see. But when I opened the income statement, the numbers shocked me. Cost of revenue jumped sharply. GAAP gross margins fell to 70.5%. GAAP operating profit fell to just $162 million. And to top all that off, stock-based compensation grew to $655 million. In this video, I want to separate things into three categories. What is genuinely getting stronger? What distortion are we seeing from the Armis acquisition? And what should we be watching in future? As I mentioned in a previous video, I did buy stock and I also bought long-dated options. So it's very important for me that I review the data thoroughly and not just look for confirmation bias against my bull case. So what I want to do is find out what changed, what the new risks are, and whether the business still operates at the level that I thought it did when I bought it. Let's start with the part of the quarter that is difficult to argue with. Demand remains strong. Total revenue reached just about $4 billion, which is up 24% year over year. Subscription revenue reached $3.877 billion, up 24.5%, and this is an acceleration from the 22% subscription revenue growth that the company reported in the first quarter. Current remaining performance obligations, or cRPO, essentially contracted revenue expected to be recognized over the next 12 months or so, reached $13.2 billion, and it also grew 21% year over year. So, total RPO reached $29 billion, also up 21%. This matters because ServiceNow is not producing 24% growth by draining its backlog. The company is still adding a very large amount of contracted business for the future. Large customer expansion also remained healthy. ServiceNow reported over 120 transactions with more than $1 million in net new annual contract value during the quarter, which is up nearly 40% year over year. The company ended Q2 with 658 customers spending more than $5 million in annual contract value, which is up roughly 23%. For a company that is already operating at this scale, those are quite strong numbers. The core enterprise platform is still expanding inside large customers, and the growth rate has not collapsed as the revenue base has become larger, which is very important to see. Next important development is AI. For a long time now, almost every software company has talked about AI. The difficult question has been whether AI is actually creating incremental revenue or whether it is simply being added to an existing product as a feature. ServiceNow gave us a much more concrete milestone this quarter. Its AI business crossed $1 billion in annual contract value. Management also said that agentic deployments of ServiceNow AI increased ninefold in 9 months. The company is positioning its platform as an AI control layer across enterprise workflows, data, security, IT operations, and third-party agents, rather than just trying to compete as another general-purpose foundation model. That strategy makes sense to me. ServiceNow already sits inside mission-critical enterprise workflows. The opportunity is to make AI useful inside those workflows with permission, governance, enterprise data, approvals, and actions that are already connected. The $1 billion ACV milestone does not mean that ServiceNow suddenly has $1 billion of new quarterly AI revenue. The ACV and reported revenue are different things, but it does show that AI is becoming commercially material rather than just remaining a product or demo or a future narrative. Now we get to the part of the quarter that initially looks much worse. Revenue increased from $3.77 billion in Q1 to just under $4 billion in Q2. It is around a 6% sequential growth, but the cost of the revenue, that grew from $940 million to $1.17 billion, is an increase of around 24% quarter over quarter. Now that is obviously much faster than the revenue growth. As a result of that, then the gross profit actually fell slightly from $2.83 billion in Q1 to about $2.81 billion in Q2, even though revenue increased by more than $200 million. And GAAP gross margins fell from 75 to 70.5%. If we stop here, then the conclusion is obvious. In only a single quarter, the business has deteriorated significantly. But that conclusion would be too simplistic, because Q2 contains a much larger amount of amortization from acquired intangible assets. At the operating income level, purchased intangible amortization increased from 77 million in Q1 to about 220 million in Q2. At the gross profit level alone, ServiceNow added back $177 million of purchased intangible amortization in its own GAAP reconciliation. This is one of the biggest reasons that the GAAP margin suddenly looks so different after the company's acquisition activity. When a company buys technology, customer relationships and other intangible assets, accounting rules can require that those assets to be amortized through the income statement. And that expense is real under GAAP, but it is not the same as saying that the core platform suddenly became dramatically more expensive to operate. There is an important nuance here. I don't think that investors should simply blame everything on accounting and move on. On a non-GAAP basis, total gross margin still declined from 79.5% in Q1 to 78% in Q2. Subscription gross margin was 80.5% in Q2. So underneath the acquisition accounting, there is some still real gross margin pressure. ServiceNow itself said that the full year gross margin outlook reflects more customers using hyperscaler partnerships and an acceleration in customer AI adoption. And this is an important sentence. AI can create new revenue, but AI workloads also consume compute. And when customers deploy through hyperscaler partnerships, the economics can differ from running everything through ServiceNow's own traditional infrastructure model. So the right conclusion is not that the gross margin collapsed from 75% to 70.5% because the business suddenly broke. The majority of that dramatic GAAP movement is heavily influenced by acquisition accounting. But the underlying adjusted margin also moved lower, and that is something that I will personally be watching. The operating margin is even more dramatic though. GAAP operating income fell from $503 million in Q1 to only $162 million in Q2. The GAAP operating margin fell from 13.5% to only 4%. And again, that sounds like a collapse in the underlying business. But look at the reconciliation. ServiceNow added back $655 million of stock-based compensation, $219 million of purchased intangible amortization, $75 million of business combination and other related costs, and $62 million of severance costs. After those adjustments, then non-GAAP operating income was $1.17 billion and non-GAAP operating margin was 29.5%. And that is a completely different picture than the 4% GAAP profit margin. But I also don't think that investors should just jump from one extreme to the other and pretend that the 29.5% adjusted margin is the only number that matters here. Some adjustments are easier to normalize than others, and purchased intangible amortization is strongly connected to acquisition accounting. But stock-based compensation is different because even though it is non-cash when recognized, it is still compensation paid to employees through shareholder equity. And as a rough analytical exercise, and this is not a company-reported metric, if I take GAAP operating income and add back purchased intangible amortization, business combination costs, and severance, if I leave the stock-based compensation as a real expense, I get roughly $518 million of operating income, or about 13% profit margin. And this is not an official accounting measure by any means. I use it only to illustrate why I think the economic reality is somewhere between 4% GAAP operating margin and 29.5% non-GAAP margin. The adjustment I care about most in this quarter is stock-based compensation. Stock-based compensation, or SBC, in the operating income reconciliation increased from $558 million in Q1 to about $655 million in Q2. And that is an increase of almost $100 million, or roughly 17% in a single quarter. Revenue increased by 5.8% sequentially, SBC increased by 17%, and SBC represented 16.5% of total revenue in Q2, which is up from 15% in Q1. This does not mean that $655 million of cash left the company. But it also does not mean that the expense is free. Equity compensation transfers part of the value of the company to employees. If new shares create dilution, then shareholders bear that cost. If the company uses cash to repurchase assets and offset the dilution, shareholders bear the cash cost instead. I would like to add a very important balancing point here though. ServiceNow's diluted weighted average share count in Q2 was actually lower than a year earlier on a split-adjusted basis, which shows that recent repurchases have offset this dilution. The company repurchased $2.22 billion of stock during the first half of 2026 alone, although there were no common share repurchase in Q2 itself. So I would not describe the current situation as uncontrolled dilution, but I do think the level of SBC is high enough that it deserves its own line in any serious valuation model. Management has committed to reducing stock-based compensation to less than 10% of revenue by 2029. That target is now especially important. I want to see SBC grow materially slower than revenue over time, not faster. Free cash flow also needs a little explanation this quarter. ServiceNow generated almost $600 million of operating cash flow and spent around $115 million on property and equipment. If you use the most simple definition even of free cash flow, operating cash flow minus capital expenditure, you get $473 million. And this is a number that we can see on some financial data platforms. ServiceNow, however, reported non-GAAP free cash flow of $634 million. The difference is that the company added back $161 million of cash outflows related to business combination and other related costs. So both numbers can be mathematically correct, but they answer different questions. The $473 million figure tells you how much the cash remained after ordinary operating cash flow and capex without adjusting for acquisition-related costs. The $634 million figure is management's attempt to show the cash generation of the underlying business after removing those acquisition-related items. For Q2, company reported free cash flow increased from $535 million a year ago to $634 million, but the margin was roughly flat to slightly lower at 16% versus 16.5%. For the first 6 months of 2026, non-GAAP free cash flow was $2.29 billion. That is a better way to view the cash generation trend than judging the business from one seasonally uneven quarter alone. Another reason Q2 looks so different is that ServiceNow has become much more aggressive with acquisitions. The cash flow statement shows $7.45 billion of cash used for business combinations in Q2 alone, and $8.77 billion during the first half of the year. The balance sheet changed with that activity, and at the end of June, ServiceNow reported about $2 billion of short-term debt and $5.4 billion of long-term debt, compared with no short-term debt and about $1.5 billion of long-term debt at the end of 2025. This does not automatically make the acquisitions bad. ServiceNow is using M&A to expand into cybersecurity, AI, identity, and adjacent enterprise workflows. So the strategic question is whether those acquired businesses can create enough incremental growth and cross-selling to justify the price paid and the additional financial complexity. But the accounting consequences are now very visible. Higher intangible amortization, higher transaction costs, higher debt, and a much more complicated gap between GAAP and non-GAAP results. And that means that investors need to be more careful when comparing 2026 profit margins directly with earlier periods. Now let's look forward. For Q3, ServiceNow guided subscription revenue between $3.97 billion and $3.98, representing approximately 20% year-over-year growth or about 20% in constant currency. The company expects RPO growth of about 19.5% or 20% in constant currency and a non-GAAP operating margin of 31%. For the full year, management raised subscription revenue guidance to between $15.76 and $15.78 billion, representing around 22% reported growth, which is about 21% in constant currency. Full-year non-GAAP operating margin guidance remains at 31.5%. Free cash flow margin guidance is 35%. And then the subscription gross margin guidance is 81%. The important combination is this. Management is raising the revenue outlook because net new annual contract value is stronger than expected, while at the same time acknowledging that gross margin pressure from hyperscaler usage and accelerating AI adoption. That is not necessarily a bad trade-off, as AI creates a much larger long-term revenue opportunity. But it does mean that investors should stop assuming that every dollar of AI revenue will carry the exact same gross margin as ServiceNow's historical software business. My overall view of the quarter is this. The strongest part is clearly the demand picture. Subscription revenue accelerated to almost 25%. RPO remained over 20%, and large enterprise deals grew strongly. AI crossed $1 billion in annual contract value, which is lovely. Management raised full-year subscription revenue guidance. Those are not the numbers of a business that has a breaking growth engine. The second point is that the 4% GAAP operating profit margin looks much worse than the underlying business because of the acquisition-related amortization that I mentioned. I would not use that 4% number alone to conclude that ServiceNow suddenly lost its operating leverage, but I also wouldn't ignore the deterioration completely. Non-GAAP gross margin fell. Non-GAAP operating margin declined sequentially. AI and hyperscaler economics are creating some genuine pressure. And stock-based compensation increased much faster than the revenue in the quarter. So for me, the three numbers to watch over the next several quarters are simple. First, can RPO and subscription revenue therefore remain around above 20% growth as ServiceNow becomes larger? Secondly, can the company stabilize gross margins even as AI adoption scales? And third, can stock-based compensation begin moving toward the management's own target of less than 10% of revenue by 2029? If ServiceNow can keep growing at around 20%, monetize AI at scale, and integrate several acquisitions successfully in the future, as well as reduce SBC as a percentage of revenue, the long-term earnings power could look very strong. If growth slows while margins remain under pressure and SBC stays in the mid-teens as a percentage of revenue, then investors will need to reassess how much of the non-GAAP profitability is truly reaching shareholders.